Hi, good evening to you all. This is Kulbhushan. I welcome you all on behalf of Marcellus Investment Managers to our Little Gems webinar. Little Gems is about to complete 5 years, and of course, like any product, it has seen different phases in its limited life till now. In our last webinar, we discussed what are the changes we are doing to the portfolio. And this quarter, the idea is to update you all on how those changes are reflecting in the performance of the portfolio, and of course, to take up queries. So I have with me our CIO, Saurabh Mukherjea, and Fund Manager for Little Gems, Ashvin Shetty. Saurabh, over to you to take this ahead, please.
Thank you. Thanks. So folks, I'll soon be in the same room as Ashwin. So until then, I'm in ups and downs. So thankfully, the ups were the first 3 years. First 3 years from August rounded at 32% net of fees. Then we went through a horrific 1.5-year phase. As many of you know, last 6 months have been much better. So April was a 10% performance month. And thankfully, June was also a plus 10% month. How did we turn around Little Champs? How did we turn around that awful 1.5 years? A lot of credit goes to Ashvin Shetty and our analysts. So I'll request Ashvin to take you through how the recovery in Little Champs continues apace. And at a time when many of the frothy small caps whose performance went up to the sky without justified fundamentals, as they see challenges to their stratospheric valuations, Little Champs with quality fundamentals, sensible valuations, continues to stage a strong comeback. So how did Ashvin Shetty turn things around? I'll request him to take over and take you through the revamped portfolio, which in the last 6 months has rolled back into life. Over to you, Ashvin.
Thank you, Saurabh. Thank you, Kulbhushan. Let me just beam up the slides. So yes, as Kulbhushan said, we had the last LCP webinar in the month of March. So wherein we touched upon the journey of LCP. It's a life of around 5 years. What went wrong, particularly between October 22 to March 24, and what changes we were making to the portfolio. So we will touch base upon what has been the progress since we make the changes in the portfolio. So this is a good slide to start with. I believe that some of you may have already seen, so at the cost of repetition, but for the benefit of folks who must be listening to this webinar for the first time. So LCP is about to complete 5 years next month, around August end. So in this period of 5 years, you will clearly see two distinct phases, right? So one is, if you just ignore the first few months when there is a COVID-related ups and downs, the portfolio had a blazing run in the first 3 years of its life. So we were compounding north of 30% till September, October 22. However, things changed, went for the downhill since then. So as Saurabh touched upon, from October 22 to all the way to say 6 months back, the portfolio delivered a negative return. Whereas both on the absolute basis as well as relatively speaking compared to benchmark BSE 500, the performance was definitely disappointing. However, we are seeing things recovering in the last few months. So April was a 10% return month, June was a 10% plus return month. So we hope to continue that momentum as we go forward. So one thing which we have talked about in before, and which we strongly believe, is that these portfolios returns are heavily linked to the earnings growth of the underlying portfolio. So as you can see, there are these gray bars. When the portfolio is doing well, this is the blue line. The earnings growth is also very solid for the portfolio. So we were clocking 20% YOY earnings growth for many quarters during that period. However, as the earnings started conking off, so did the returns of the portfolio. On the positive side, we are seeing after a gap of nearly 3 quarters, the earnings of the portfolio going up. And as a result, the return is also following. So this is one singular focus of turning around the performance of the LCP portfolio, is that we will focus on having companies in the portfolio which will deliver the earnings growth. And we believe that should also translate into the returns. Another way to look is correlation between the earnings growth and the portfolio return is this slide. So the left-hand side table is the detractors, the top 10 detractors for the LCP portfolio, particularly during this since October 2022. You will find that invariably, except for a few exceptions, the PAT for these companies were also saw significant decline. So that resulted in the share price decline for these companies. On the right hand side, you'll find that the opposite is true. So the share price of these top performers that is also backed by the PAT growth, healthy PAT growth for this set of companies. So this also kind of corroborates our view that earnings growth is essential for this portfolio. And if we are able to deliver earnings growth for the portfolio, the return should also follow suit. Having said that, there were some extraneous factors which also kind of put the LCP stocks out of favor, particularly in the last 2.5 years. So as again, some of you may be aware, this is the forensic framework of Marcellus. So basis the 11-12 accounting ratios, we classify the accounting quality of our universe on decile basis. So D1 being the best on the accounting quality and D10 being the worst. And you'll find that calendar year 18, and we classify that first top 50% decile as zone of quality and the bottom 30% is the zone of darkness. The name actually describes the features of this company. So you'll find that during calendar year 18, 19, 20, and even 21, the zone of quality invariably did well. In other words, the company with the best accounting quality, company with sound governance practices, they performed, their returns were substantially higher than that of the zone of darkness Vale companies. And particularly this period of drawdowns, you'll remember that the SMID generally universe went through a lot of drawdowns in calendar year 18 and 19. The zone of quality really shined through during that period of drawdowns. However, things changed, particularly for calendar year 22. And it only exacerbated during calendar year 23. So zone of darkness companies started doing well, the subpar accounting quality companies. And because in LCP, one of the, if you remember, one of the pillars of portfolio construction is around having clean companies in the portfolio. And this we believe is particularly important for small caps, where if we end up investing in dubious companies, it may do well for a while, but when things blow up, we will be basically there'll be a lot of drawdowns in the stocks. And unfortunately, these companies have done well in the last 2.5 years, and that has also impacted the LCP portfolio, which are primarily invested into the first 6 deciles, basically.
Folks, this point that Ashvin is making, right, is central. Whilst we are to blame for that 1.5 years of hammering that we got from September 22 through to early part of this year, 1.5 years, the LCP basically gave negative returns. It's also true that in that 1.5 years, the companies that did well, you can see, right, in CY23, in the first half of this year, the companies that did well are companies with weaker accounting. And whether it is whatever concerns that there might be in the market about capital gains tax, whether it is the coalition government construct that's in power in Delhi, whether it is an economic slowdown, it's when the tide goes down that Warren Buffett famously said, it's when the tide goes out that you can see who's swimming naked. This is my third cycle in India of watching the same cycle of watching low quality stocks. Decile 7 through to 10, zone of darkness stocks outperform quality stocks. And these things usually turn. And when they turn very quickly. The bigger part of the small cap rally in India has been the low quality names. You can see that very clearly in the table that Ashvin has presented, especially we summarized it for you. Zone of quality, D1 to D5. In the lower 3 rows of his table, he summarized it for you. You can see zone of darkness 8, 9, 10 has had spectacular rallies in 2023 and the early part of this year. That's going to unwind. We can't time it for you. Our job is to stay positioned in the zone of quality, invest in good quality small caps, good fundamentals, high quality accountings, earnings growing at a decent rate, and be patient, because when the tide goes out and the zone of darkness guys are unveiled as being
low quality small caps, the world will come towards the small caps that we are buying in LCP. Back to you, Ashvin.
Yeah. And another way of looking is again this. For example, we have had a similar instance in the past when temporarily the zone of darkness they outperform the zone of quality. For example, if you in the previous cycle, calendar year was one such instance where clearly the low quality or low accounting quality companies they did outperform. But then we saw that things came crumbling down for this set of companies in the next 2 years. We have seen these cycles before. And if I extend this period, we unfortunately don't have the data, but you'll find that such instances where temporarily these set of companies do well, but then they are not able to sustain the performance. And if you look at the long-term CAGR, so this is for the last 7-8 years, calendar year 16 to 23, definitely you'll find that zone of quality over a reasonably long time period, they do outperform the zone of darkness. So in this particular instance, there is a 300 basis point difference over a 7-year, 8-year period. So as a result, we firmly believe that we will remain invested in good quality companies. And this is especially important, we believe, for a small cap portfolio like Little Champs. So no change in that philosophy. So the initiative, so what are we doing or what steps we have been taking in the last few months to remediate LCP performance? One is that not to be swayed away by what is happening in the market with regard to the companies which we talked about. So we'll continue to stay away from that. But more importantly, as I said, we will continue to be very demanding of the portfolio companies in terms of evaluating their earnings growth prospects. So wherever we think that the earnings growth prospects look bleak, we will get out of that companies. We have been getting out of that companies in the last few months, and it will be replaced by the companies where we think that the earnings growth prospects for the next 2, 3, 5 years look very, very strong. Secondly, we'll touch about the discovery aspect in a bit. And thirdly, as I said, we will keep a very hard view of the incumbents in the portfolio. Are they able to have they in them to recover the earnings or maintain the strong earnings growth? And coming to new stocks, getting new stocks discovery back on track. This is very important, especially for small cap portfolio like LCP. And again, this is one chart you must have seen it before also. So the whole premise of launching LCP 5 years back was we basis this analysis. What we found is that the best return, the stocks that generate the best return in the Indian markets are the stocks which are on their way to entering the BSE 500. So this red is the gate to BSE 500. You will find that the stocks which are 1 year, 2 year, 3 year away from entering the BSE 500, they deliver very, very healthy returns. And mind you, this is just the outperformance number over the BSE 500. So on absolute basis, actually, this number would even look better. So what we aim to achieve in LCP is to find this set of companies and invest in them whilst they are getting bigger and they are potentially getting into BSE 500 and reap the benefit of the returns that they generate on their way to entering the BSE 500. A large part of this returns obviously come from the earnings, but there is also a discovery effect which is into play. So many of these companies, because they are small in size, because they are not investable for the large funds, mutual funds or institutional investors, and hence, despite having very good fundamentals akin to a very good quality large cap, but they trade at a fraction of the multiple which their equivalent mid cap or large cap come at, because these stocks are very small. So as a result, our objective is to invest in these companies at that point in time when they have been largely ignored by large investors, getting at a very good valuation multiple. And then as these companies deliver earnings and as the market, they get bigger and as the market keep on recognizing their earnings delivery and as the PE rate get out of those companies, basically. So these are the whole premise. And in fact, we were very successful. The initial batch of LCP stocks, which we invested in calendar year 2019 and even calendar year 2020, many of them actually went on to become multi-baggers. For example, Alkyl Amines, we invested when the multiple was, I think, in early teens, less than 15 times we invested in Alkyl Amines. it over the period of next 3 years, thanks to its performance during COVID period. The multiple all the way went up to 55, 60 times, even more actually. So obviously it delivered the earnings also, but there is also a significant re-rating in the multiple of alkyl amines which we happen. And hence alkyl amines, despite the drawdown we have seen in alkyl amines in the last 2 years, on a 5-year basis, it still continues to be top 3 performer in the LCB portfolio. Such was the sharp move in the stock during the first 3 years.
And Ashwin, if you don't mind my saying so to everybody who's listening, this was Ashwin's sort of great insight 6 years ago when he pointed this out to me. The chart that you see on the top left, 6 years ago, he pointed this out to me, and it was breathtaking to see it, and it plays out year after year. This chart plays out. 2019, 2020, 2021, all the way up to September 22, we executed this to perfection. But 2021 and 22, we weren't able to travel much courtesy the COVID restrictions, and the discovery piece suffered. And we paid for that. We paid for the fact that we didn't travel as much through 2021 and 22. We paid for that in our woeful performance in 23. Over the last 7-8 months, we've been on the road actively again, discovering stocks through desk research, then going and visiting factories, meeting dealers, meeting ex-employees. And again, the results are there to see in LCP's recovery. Ashwin will discuss with you some of the names we bought. But this is an essential part of LCP. This is why LCP exists. Spot companies when their market caps are 2,000, 3,000, 4,000. Figure out other accounts clean. Does the promoter allocate capital efficiently? Is it a niche franchise with dominance in that niche? And you can't figure that out sitting in your laptop and playing about with your Excel spreadsheets. You have to go out and about in the real world. Now that we started doing it again over the last 8-9 months, the results are coming through nicely, and I think you'll see this playing out beautifully again in the years ahead, much like it did in 2019, 2020, and 2021. Back to you, Ashwin.
Yeah. So obviously, what Saurabh said, one was a travel restriction which impacted the discovery, but there is also, for example, a lot of distortion which in the earnings which was brought upon by COVID. Honestly speaking, it became very difficult to differentiate what is one-off sitting in the confines of home in limited information. So what is one-off, what is sustainable earnings, and so on. And obviously, nobody knew COVID, how long it will last, whether it will be 6-month phenomena, it will be a 2-year phenomena, or it might as well last 5 years. So things become very difficult for us to focus on a discovery building element, and hence the rate of additions of deletions in the portfolio that took a backseat. Having said that, Saurabh said now that we have a clean set of financials, particularly coming from FY23 onwards, so we have refocused on the discovery element. Another thing, Saurabh, you want to talk about this?
Yeah, sure. So if 6 years ago Ashwin's discovery chart was the big insight, more recently our colleague Nandita scarred through the corporate tax data that the government of India publishes. Now, for reasons I can't tell you, reasons I'm not privy to, the government publishes the corporate tax data with a big lag. So a month ago, the government published the corporate tax data for the year to March 22. Right. So by corporate tax data, I mean the government publishes how much tax was collected with companies with profits between 0 to 5 lakhs, how much for 5 to 10 lakhs, how much for 10 to 20 lakhs, so on and so forth. Right. That stratified data on kitna size ka company ne kitna tax pay kiya for FY22 was just recently published. What that data is showing us basically is that in India, the country has segregated very nicely between the rulers. Rulers are giant companies, profits of $60 million. $60 million matlab करीबन 500 crore ka profit. So rulers are big companies. Remember, the government corporate tax data doesn't distinguish between listed or unlisted, right? So the data that they're getting is the rulers, which is big companies with 500 crore plus profits, market cap of basically $3 billion and upwards. 20,000 crore ke upar ka market cap, their profits over the last decade have grown at around 15%. But the really stunning bit of insight that's emerging from the government data is not the rulers, but the 5,000 companies below the rulers. 5,000 companies with profits between $5 million to $50 million. मतलब lower end पे 30-40 करोड़, upper end पे 400-450 करोड़, 30 to 40 crores at the lower end, 400 crores at the top end. This group of companies, roughly 5,000 companies, we call them challenger franchises, 5,000 companies are roaring away. So in the chart on the top left, in the left-hand side chart, this is Decile 2. Decile 2 in India, not the biggest companies. Decile 2 in the post-COVID world has turned out to be the fastest growing decile. If you look at the chart on the left, right, look at how post-COVID, the upper wala line, the black line, which is Decile 2, look how the line slopes steeply upwards, right? Now, we're trying to fully understand what happened. Why is it that post-COVID Decile 2's profit growth took off? Why did the challengers, 5,000 companies below the top 700, 800, why did the challengers pull away so aggressively from the rulers post-COVID? We don't have a full answer yet. Our suspicion is this is a combination of the country taking to UPI in a big way. This is a combination of social media marketing becoming established. This is a combination of the aggressive expansion in the road network that's been expedited in the last decade. Road network expansion, the airport network expansion bearing fruit. And this is also the kind of the fruition of the post-GST world. Remember, GST 2017 mein aaya, and the sort of integrated Indian economy really took off in the post-GST world. The result of this is that an LCP company finds itself on a level footing to say a CCP company for the first time. Just to put it in Marcellus jargon, for the first time in Indian history, courtesy zero cost transactions, low cost marketing online, high quality infrastructure being available to all, GST making it easier to do national level logistics and warehousing. An LCP company like say a Thailand finds itself on a level footing to a giant company, say such as an Havas, right? ये पहले हुआ नहीं है इंडिया में, and this dynamic we think is very exciting. The government tax data, honestly, the challenge in the right hand side chart, the challenger dabba, the challenger dabba, the challenger quadrant of that, just 1 to 1.5% of India's companies, 5,000 companies growing profits rapidly, 26% CAGR in the last 10 years. Sorry, 16% CAGR in the last 10 years, 25% CAGR in the last 4 years. This is LCP dreamland, and this is where a lot of our discovery is going to happen. So the government tax data suggests that the whole discovery construct that Ashvin had created 6 years ago is really working out far better than we'd expected in terms of reality in the world outside. Now it's incumbent on us, the team at Marcellus, to do the relevant mehnat, the relevant groundwork to keep discovering new companies every year, a fresh batch of companies, and making sure that through our newsletters, through our webinars, through our media appearances, we tell the world about chota companies, market cap of 2,000, 3,000, 4,000, profits of 30, 40, 50, 60, 70 crores. Tell the world about them so that the world discovers these great companies, and our clients get enriched in the process. Back to you, Ashwin.
Yeah. And as we said, we had a plethora of discovery in the last 12 months. So we, in fact, there are almost 16 new entrants in the portfolio in the last 12 months. So have we been successful in terms of these new stock additions? So this table shows that the share price return since entry for this new 16 entrant is averaging close to 17%. And mind you, this is the return from the date of entry to 15 July. So many of this we have discovered over a period of last 12 months. So if you take the average life as 6 months, so you'll find that the return is quite healthy on an average or the median basis. Similarly, as I said, like the LCP portfolio earnings in the last 12 months have been the negative zone, which is shown in the first slide. But when you look for the new entrants, they're healthy. Their earnings growth stands out. And again, here there are two companies which is pulling down this average number. So that is PDS and Everest Industries. So in fact, if you remove these two entrants, the earnings growth jumps to around 18 to 20%. And Everest, again, we had talked about it last time. So when we actually invested in Everest Industry, it was a loss-making company, and we were conscious that the earnings in the near term wouldn't look great. We invested with the belief that we will see a strong turnaround in the earnings performance as we go forward. So this was something we consciously invested. But the moot point is that the new entrants have outperformed the incumbents in the portfolio, both in terms of share price return as well as in terms of the earnings growth. So this makes us again believe that whatever the change in the gears that we have adopted in the last 12 months, that seems to be working for us. And of the 16 names, we had discussed 10 names in our March webinar, so we'll not touch upon that. But the 6 new additions which we have done since then, so we'll briefly talk about it. So one of the names which we added in the month of March was Caricil. So Caricil makes the Scotch sing. So basically, many of us must be aware of the stainless steel sinks, which most of us use, but there is also a quartz sink, which is there. It's more aesthetically pleasant, and also it has some functional benefits. Like, for example, it doesn't make, in a steel sink, the water makes a lot of noise. But in a quartz sink, it doesn't make noise. So Caricil is actually one of the top 5 makers of quartz sinks globally. It is definitely a leader in India, but globally also it is a top 5 company. Now, what we like about this company is Caricil uses a technology for manufacturing quartz called shock technology. Globally, only about 5 to 6 players have this technology. So this technology was invented by a German company called Shock somewhere around 40, 50 years back. It used to earlier license this technology. It was not manufacturing this technology. It was an inventor of the technology. It used to license this technology to various players. Caricil charged upon this technology because there was a joint venture between Shock and Caricil at one point in time. But around 25 years back, Shock itself made a foray into manufacturing of quartz zinc, and since then it has stopped licensing this technology. So as a result, this technology is privy to only a handful of players now, and Caricil is one of them. This is a very robust technology, both in terms of the manufacturing process that is involved, as well as the use of the material. For example, adhesives is a very secretly guarded technology. So as a result, this serves as a very strong entry barrier for anybody manufacturing quartz sinks via shock technology. There are other ways of manufacturing quartz sinks. For example, there is a polyester resins which we can use, but clearly the ones manufactured using a shock technology stands out in terms of durability and other functional properties. So this is one big moat which Caricil enjoys. And we also see a lot of growth drivers for the company. So one is that it's the quartz share. If you see the overall sink market, stainless steel dominates the market, anywhere close to 70-80% of the overall kitchen sink market. So quartz has a long way to go in terms of taking share, and it is happening. It is happening, but there is a lot of a long growth runway. And over the years, the pricing gap between the stainless steel and quartz has also come down because steel prices have continued to go up. As a result, we think that we will see at an accelerated pace the shift happening between stainless and quartz sinks as we go forward. So that is one big growth driver for Caricil. And within the quartz sink market, most of the, if not all, of Caricil's competitors, they are based out of high-cost geographies like Europe because of the legacy reasons. And clearly, we know that the energy cost in Europe has gone through the roof in the last 2-3 years because of the geopolitical issue. So as a result, this Caricil, which has a manufacturing plant in Bhavnagar in India, so clearly from a cost perspective, Caricil stands head and shoulders above its peers and is able to price its product competitively and gain market share from the European peers. So we think that Caricil will see market share gains within the quartz market. And finally, the management has been very, very sound about its capital allocation policies. So beyond quartz, it has entered into adjacencies in stainless steel itself, but in a premium category of stainless steel. Plus adjacencies like surface tops, kitchen surface tops, which are made of quartz and so on. And it's a combination through both organic as well as inorganic foray, and these have done well over the years. So most of these adjacency segments are generating 20% plus ROC for Caricil, which indicates that the management's capital allocation has been on the money. So Caricil is one stock which we have added. We see strong moat here as well as a strong growth drivers for the next 3 to 5 years for the stock. Second stock is Godrej Agrovet, which we had touched upon in the Rising Giants webinar. So Godrej Agrovet actually is a known name, it's not a discovery as such, but the stock didn't do well from earnings perspective for a long period of time, especially since its listing from 2018 till FY23. So one big issue that the company suffered was the huge volatility in the commodity prices, particularly during the COVID period. And many of the raw material for its division, like animal feed division, etc., it went through the roof, and it impacted the margins of the company. Similarly for the dairy business as well. So between FY18 to FY23, the earnings growth was quite muted at 6% CAGR, and hence the stock fell out of the favor of the investors. And we started researching on the stock around 6 to 8 months back. We found that the commodity prices were stabilizing after a long period of time. Secondly, we also saw a lot of improvement being done by the company. For example, 3-4 years back, most of the division products were commoditized in nature, and hence the pricing power is very, very limited. But we saw that the company is improving the salience of value-added product across its division. For example, in dairy, now almost 40% of its revenues come from value-added products like ice cream, milkshakes, and so on, where the pricing power is relatively better. Similarly, in the palm oil division, the company has invested in refining capacities. So where again it has a better pricing power than just selling the crude palm oil to the B2B players. So the salience of value-added products consciously has been improved. So company is much better placed now to deal with future fluctuations in commodity than what it was in the past. Secondly, we also find a lot of macro tailwinds, especially for the palm oil division. Earlier, the problem used to be that there was no MSP type support for the crude palm oil, and it's a volatile product globally. It's driven by the global prices. And hence, when crude oil prices were high, farmers or the cultivators used to plant palm trees. But whenever the prices went south, they used to uproot the palm oil plants. So as a result, there's a lot of this sector never took off in India, despite a huge opportunity. For example, 80-90% of the palm oil is imported in India. So there's a huge opportunity for growing this crop indigenously. But what happened is around 3 years back, the government came with a scheme called National Mission on Edible Oils, Oil Palm, wherein through a mechanism, it now provides a minimum floor price. So if the global price or the crude oil market price of crude oil palm goes below that price, the government compensates it to the farmers. So that has actually helped, that has provided an assurance to the farmers. And hence, we have seen a good offtake in the crude oil plantation, the hectare under cultivation that is happening in the last 3 to 4 years. And we think that this will definitely benefit Godrej Agrovet. It's the leader that almost has 33% market share in the total area under cultivation of the crude oil palm. And thirdly, some division, the company has also made it, for example, has very strong partnership with Disal Chemical Corporation, the crop protection business. So that has done well in the last 1 year. This partnership has really paid off. Similarly, in the Aztec division, company traditionally used to have commodity products in the enterprise division. It has around 6 to 8 months back set up new CDMO facility. And we think that things should turn for the Aztec subsidiary as well. So in short, we think that the company is much better placed than what it was a couple of years back. And we already seen that in the numbers. For example, FY24 was a good year after a long time for the company. The earnings went up by, I think, more than 30% in FY24. We think that given where the valuation and given the scope for the earnings growth, we took a bet on Godrej Agrovet. So we think
folks, if like Ashvin, you visited their factories, visited their distribution center, this is a colossal setup. I think there are 15 different factories for animal feed, for dairy, for fish feed, so cattle feed, fish feed, for crop protection, three large R&D setups. So we were just amazed that we could buy a company of this scale at basically a little over $1 billion valuation. Colossal company, market leading franchise. We think there's lots of money to be made here, and we were just delighted that we could get it at the entry level valuation that we did, and with so little institutional ownership. with Shivraj Singh Chauhan as the Agri Minister, with the heat now on for the NDA to deliver for rural India. I think there's likely to be agri reforms as well, which could potentially play out for Godrej Agrovet. That will just be the icing on the cake if that comes through. Back to you, Ashvin.
Yeah. Another stock, Eureka Forbes, again, it's quite known. I think most of us would be aware of the brand called AquaGuard, must be using it also. So Eureka Forbes is actually a 40-year-old company. But what the change here is that this company used to be owned by Shapoorji Pallonji Group until 2 years back. The company, while AquaGuard brand is very strong, but the company over the last 10 to 15 years, it has not performed well. Despite it has been found lacking in terms of product innovation. For example, one of the important changes that happened in the water purifier industry is the reverse osmosis technology, RO, which we know. That has come into play. And Eureka Forbes actually, despite being a market leader, it was behind the curve in terms of adopting this technology, and similarly other many instances. So as a result, the company underperformed over last 10 to 15 years. But what has changed here is that there is a new owner which has come in. Advent has invested in this company, and it also bought a very strong team led by Pratik Pota, ex-Jubilant Foodworks. And we are seeing things changing in the company in the last 2 years. We have seen the R&D innovation pipeline firing again for the company in the last 2 years. And we see that the growth opportunity huge. For example, the water purifier penetration in terms of household is just about 5%. And when we compare it with other consumer durable categories like refrigerator, and those must be around 25, 35, 40%. So there is a huge scope for the water purifier penetration, just not even touching double digit as of now. So that is one important growth driver. Second is that it's a very typical, unique industry that water purifier, unlike, again, other consumer durable categories, it's just about product revenue, right? You sell the product. But here, actually, this product requires AMC, annual, basically the maintenance, periodical maintenance, because the filter which is used in water purifier, that needs to be changed every 6 months or a lesser frequency. And that provides a recurring stream of revenue for companies like Eureka Forbes. Again, for the company, because of the lack of whatever reason, it couldn't fully enjoy the benefit of this business model of AMC. And hence, of the total installed Eureka AquaGuard water purifier, the company was only servicing about 25% of the total install base. 75% was done by the local players using spurious filters or other parts. So here also company has got its focus back. It is heavily marketing the dangers of using spurious filters. And at the end of the day, this is a health-oriented product. If you drink dirty water, you can actually fall sick. So there is a lot of campaign which is being done by the company. Similarly, the companies also brought on the price point that you don't need to take like a full 3,000, 4,000 per year AMC. You can actually start the service by taking 600 rupees. The service, the technician visits, inspects, etc. So it has brought on, it has improved the affordability of the service. And again, this can provide a significant growth opportunity for the company. So simply 25% can, if it goes up to 50%, if the company is able to service 50% of the installed base of AquaGuard filter, that itself can provide a big growth opportunity. And this is a high margin. Service is a high margin segment compared to the product revenue. And another good thing about service revenue is that you get money in advance. So basically, for example, if any customer is taking 1 year or 3 year AMC, the payments are done upfront. So from a working capital perspective, this is a very formidable business model. So we are already seeing results of the changes being brought by the management. For instance, FY24, after a long period of time, the product revenue touched double digit for AquaGuard. And we think that this momentum should continue. And this company can be much bigger in size in terms of, and what it is currently. We see a huge potential for here. And moving to another company which we added in auto component space is RACL Geartech. Again, many of you must not have heard about this company. So actually, it's a hidden gem. So basically, unlike most of the Indian auto component company, which derive most of their revenue from the domestic segment, RACL Geartech actually derives 70-75% of its revenue from exports. While the export journey was started out of compulsion, because the company really started under the new management around 20 years back. Already the domestic auto company industry was it was like OEM and vendors were pretty well established. So as a result, the company started looking for the export market, and it has done a good job in the export market in the last 15 years. The major customers for the company in the export market is the likes of BMW, likes of KTM, likes of ZF, and we believe that these are all premium motorcycles, and hence you need to be a very sound technically strong vendor to supply to these premium motorcycles. And that is a strong testimony of RACL Geartech. And we think that that is possible because of the technocratic, the promoters are technocrat in nature, and they invested in the best quality machines and equipments. So we believe that that has actually driven these premium OEMs to source from RACL Geartech. So as a result, when you look at margins of RACL Geartech, it stands significantly ahead of the conventional auto component company component. So we see that this is a strong moat. It's very difficult to penetrate into this premium likes of BMW, ZF. You need to be really good in quality, in terms of delivery, in terms of reliability to enter. And RACL has done the great job here. Now, what they have to do is to basically keep on penetrating more and more. For example, ZF, RACL got an entry into ZF, which supplies, again, transmission parts to the like of Daimler, Mercedes, and so on. But it is still scratching the surface. So it is continues to do the good work. We think there is a huge opportunity for them. So this is one, again, stock which was available at a very good valuation, and we see that this company can grow its revenues for the next 3 to 5 years strongly. It can be significantly bigger in size than what it is currently, and hence we invested in RACL Geartech. The last two companies, Ahluwalia Contracts. Again, you must be a surprise to many that we have invested in an EPC company. But really, we found that Ahluwalia Contract is a very good company. When we look at their track record in terms of their balance sheet, clearly there is no debt in the balance sheet. That gave us a lot of comfort. But more importantly, looking at the track record of project execution delivery, because one reason why the EPC company, or for that matter any construction infrastructure company, suffer is when you have a lot of slippages on the project execution. Here we found that Ahluwalia has a very strong track record of delivering the projects on time. And the promoter involvement is very high in choosing the kind of projects that they want to invest in, what can be the working capital drain, and so on. So project selection has been very strong for Ahluwalia Contract. And finally, it's not that company was always doing well. Around 12-15 years back, this company also struggled, but it drew very strong lessons from that. And hence, from that point in, the company has been very choosy about what kind of projects they want to get in, what kind of customers they want to deal in, and so on. And it has been a one-way journey since then, in the last 12 years. So here also, here again, we think that the company, given its track record, has a huge scope. And we're already seeing that in terms of the size of the projects that it is now getting in. It's almost competing with the likes of L&T in terms of the order sizes that it is winning. And given the current size of revenue, we think that as the company continues to get into bigger league while maintaining prudence around the balance sheet and prudence around the projects that it selects, this company can deliver strongly over the next few years. And lastly, Stylab Industries. This is a company we actually chanced upon when we were researching for a bigger name. We looked at the fundamentals and we were really wowed by looking at its fundamental track record. For instance, the company has been, the last 5 years, the earnings growth for the company was easily north of 25%, while maintaining, again, more than 20% ROC. Then we dig deeper into these industries. We met the management and so on, and we came away impressed. So I think one thing where Stylab Industries, it's a maker of laminates basically, is that it has a very strong export franchise. So almost 2/3 of its revenues come from the export market. And that company has built over the last 30 years or so, and it enjoys very strong competitive advantage in terms of distribution, distributor relationship, in terms of the granularity of the market. For example, it is presence across more than 100 countries now. So that gave us a lot of comfort that it's not dependent on one distributor. It's not dependent on one single country. It's a very granular book of exports that Stylab has. And we also came away impressed with the frugal setup of the company. For example, Stylab Industries has been entering, it's always focused on the export market. It's only in the last 5-6 years that it started looking at the domestic market, and hence it's a challenger in the domestic market. It is priced its product in the domestic market quite competitively, despite having near about similar quality as the likes of Merino or Greenlam. The laminate price in the domestic markets are at significant discount, 15, 20, or even more. As a result, the gross margin of the company is on the lower side when you compare with these bigger companies. But when we look at the EBITDA margin, it's in fact better than these companies. So we firsthand actually witnessed the frugal setup of the company, and we believe that that really is a very good thing about this company. So this again we like. And again, here we think that even after being in the export market for 30 years, its market share in the global laminate market is just about under 5%. So there is a huge growth runway for Stylab Industries in the export market. And hence, we invested in Stylab Industries. So this was the sixth stock which we added, most recent entrant in the Little Champs portfolio. And again, this is a slide quickly on this. There are some incumbents where we continue to stick around with. So one is alkyl amines. Again, company, as I said, did very well during COVID period. It's been struggling in the last 1.5 years. When you look at alkylamines, there are 3 engines of alkylamines. So one is the methylamines, second is the ethylamines, and third is acetonitrile. So methylamines and ethylamines are doing well. They're fairly stable for alkylamines. Because methylamines is a very hazardous product, it's a very volatile product. It's very difficult to transport, and hence basically it's all domestic supply and demand for methylamines. So fairly stable industry. Similar is the case for ethylamines by and large. Acetonitrile, which did very well during COVID. Unfortunately, that is the product which is giving a lot of pain to alkylamines in the last 2 years, primarily because of 2 reasons. One is that whatever extra demand that got generated during COVID, that has gone quite understandably. But what more importantly happened is that China, which was absent during COVID period and which resulted in a very strong demand supply economics working in favor of alkylamines. China has come back strongly in the acetonitrile market since the last 1.5 years. And we have seen the imports from China coming very strongly, especially since the period between last year, April 2023 to November 2023, we saw acetonitrile imports from China, Taiwan, even other countries like Taiwan, etc., coming into India market and at a very low realization. So that hammered the earnings, especially in FY24 of alkylamines. Why we continue to stick with alkylamines is, again, as I said, like there are 2 engines which are stable and which are doing well for alkylamines. In acetonitrile, we are seeing a couple of positive development. One is that we are seeing the imports which were going one way up till November, that has been coming down. or slightly coming down in the last few months, and also acetyl prices, which had gone all the way down to $1.4 during November, that is also stabilized, in fact, inching up slightly. So as we speak today, the latest price is around $1.6. So we see that the pain of acetyl is stabilizing. Secondly, there is also anti-dumping investigation which has been opened up against these imports. So any favorable outcome over there, I think we should see a very strong pickup in the acetyl volumes as well as margins for alkylamines. Having said that, we have cut down the position. At one point, we used to have almost 9 to 10% of portfolio in alkylamines. We have brought it down to about half of that now. But this is something where we continue to be hopeful of earnings recovery, especially in FY25. Second stock, more or less around same line, is GMM Pfaudler. Again, the stock did very well during COVID period. This is actually the FY22 dip in earnings is because of exceptional. If you remove the exceptional, the numbers will look very strong for FY22 as well. What has happened in the last 12 months is because of the slowdown in the chemical space and the cut down in the capex by these companies. GMM's order book has seen deterioration, and that has also negatively impacted the margins of GMM Pfaudler. Again, here we have cut down the position, but we continue to hold the stock because we are seeing some green shoots. For example, in the last 2 quarters, we are seeing the order book improving for GMM Pfaudler. Secondly, the company is also looking beyond the glass-line equipment. So glass-line equipment has been the mainstay of companies till about 4 years back. During COVID period, the company invested in it made 5 to 6 acquisitions. And by virtue of doing so, it is also now getting almost 40-50% of the revenue beyond the glass line equipment, like mixing systems, which globally is as big a market, if not more, than glass line equipment. So there are new growth drivers which the company has built. So as a result, we continue to hold GMM Pfaudler. We think that FY25 should be better than FY24 for GMM Pfaudler. And finally, Tarson's. Tarson's, again, the same story. Did very well during COVID period. But as COVID went out of our lives, so did the earnings of Tarson's. But again, here we are seeing green shoots. So when we look at the export volume for the last few months, so exports were going down by almost 20-30% through most of FY24. In the last 2 quarters, we are seeing exports now bouncing back to double-digit growth. So we are seeing signs of improvement over here. And similar to GMM Pfaudler, Tarson's is also working on new products. For example, one important product that it is working on is cell culture. So far, it has been the product which only MNCs have been able to master, the likes of Corning, Thermo Fisher, and so on. But Tarson's have actually getting into cell culture, and that is as big a market as Tarson's existing products. So the next 3 to 5 years, that can be a strong source of earnings for companies.
And Ashvin, if you don't mind my saying, so one point I'll make, folks, is whether a stock is working out for us. Yeah, Godrej Agrovet has done really well for us, or not working out for us. We haven't made any money from Tarson's in now, I think, 3 years. We haven't made any money from GMM in the last 3 years, or from Alkyl. Whether a stock is working out or not working out, our job is to stay on top of it, on top of the stock, meet management, meet primary data contacts, meet distributors, meet dealers. And as long as we believe the business continues to be run pretty well, whether it is Alkyl means or Godrej Agrovet, as long as we believe the business continues to be run pretty well, the franchise is in good shape, we stay in there. We can't pin it on the promoter that the cycle has turned against you. No point going to the Kothari family and saying China is dumping acetonitrile. There's not much they can do about that. They've done what they can. Alkyl means has filed an anti-dumping suit with the government of India. As long as the management team is doing its job, if the cycle has turned against them, it behooves us to be reasonably patient and hang in there, albeit with a smaller position, knowing that one day the cycle will turn in the company's favor. And I don't think we can claim we will be the first people that the Chinese will call when they stop dumping chemicals on the rest of the world. The day the Chinese stop dumping chemicals on the rest of the world, obviously Alkyl will be a massive beneficiary. So will be GMM Pfaudler, so will be Tarson's. But since I don't think Xi Jinping is going to call up Ashvin Shetty to inform him that tomorrow morning we're going to stop dumping chemicals, our job is to stay on top of the company, make sure that the company is doing its bit to produce a competitive, high quality product, check with dealers, check with distributors, check with competitors of that company that indeed the product is high quality, and stay invested. When things are going swimmingly, as was the case till September 22, this type of investing feels like the world's greatest thing. When things turn against us, as they did for the 1.5 years from September 22 to the early part of this year, this feels like a bad way to invest. But I can assure you, I haven't done this for a long time. This style of investing, you look for smaller companies, 2, 3, 4, 5, 6,000 crore market cap, and ensure that the promoter is an honest guy, the promoter family are honest people. Check capital allocation, check niche dominance, and then load up and stay patiently invested. It works out pretty well. Even after the torrid run that LCP had between Sept 22 and the closing months of 23. Even after that, over the last 5 years, net of fees, we've delivered for clients 17%. Yes, other small cap funds have done better. Hopefully, as the discovery process continues, we can get back to what we were doing for that first 3 year period of LCP, which is compounding at 30% plus net of fees. Back to you, Ashwin.
Yeah, so I'll quickly, conscious of the time. So basically, just to sum it up, I think we are expecting a much better earnings growth this year than what has been the last 3-4 quarters. Also aided by the new additions that we have made in portfolio. One good thing about is that obviously there is a favorable base effect which will come into play. So optically also the earnings should do well. And as I said, in a few cases, especially in the export stocks, we are seeing green shoots of pickup. We are seeing double-digit growth in export volumes for some of our portfolio companies, which used to be double-digit decline until a couple of quarters back. So that is also quite heartening. And finally, these companies, as Saurabh said, they have done what they have to done. So they have not been bogged down by the slowdown. They continue to reinvest in the business. And for instance, the last 3 year investments itself is contributing close to 30% of their capital employed. So many of these companies would be 15, 20 years old easily. And last 3 years, capital employed itself is contributing 26%. So they have in fact doubled down on investing back in the business during period of slowdown. Historically, that has paid off very well for these companies because whenever the demand have come back, these companies had the capacities in place, and as a result, they have been able to benefit non-linearly from the demand recovery. This time also, they have not taken a back seat. They have played on the front foot, and we believe that that should also help these companies. And finally, this is the phase-wise return. So we are seeing, obviously, this period was very bad. But in the last 3 months, we are seeing the recovery in the returns. So we hope to continue that momentum as we go forward. So I think I'll end here. Kulbhushan, over to you for questions.
Thanks, Ashwin. Thanks, Saurabh. This was really insightful. Now, we have few questions from investors, and I'll start taking them one by one. So one question is around the strategy that while in recent past we have seen LCP being diversified and as a result churn ratio also increased a bit. At the same time, we have entered into let's say Eureka Forbes, which seems to be a turnaround pick. So going forward, will we also be doing turnaround plays in addition to discovery stocks?
So I'll take, Saurabh can add. So basically, Eureka Forbes, when you talk about turnaround, it comes to mind that the balance sheet would be very leveraged hoga balance sheet and so on. In case of Eureka Forbes, actually, or Godrej Agrovet also for that matter. So the balance sheet has surplus cash actually, by the way. A very strong brand. Only what we are betting on is that the new management coming in and delivering, helping the franchise deliver to its fullest potential. So we think that all the things that ought to be is there. They need that basically management agility, which was missing so far. So that is what we are betting on in case of.
Yeah, so I'll just echo what Ashwin is saying. We're not investing in companies where it's a weak brand, weak balance sheet. Whether it's Godrej Agrovet, whether it is Eureka Forbes, in both cases, they are market leaders in what they do. Both are companies with healthy ROCEs, healthy balance sheets, good margins. The only thing is, we believe in both cases, a Godrej or a Eureka Forbes, the profit compounding can be way more superior than it was in the last several years. So the Eureka Forbes, I think, under the erstwhile promoter family, there's barely any profit compounding for a decade, even though it stayed the preeminent water filter, water purification brand, courtesy AquaGuard. And similarly with Godrej Agrovet, whether in cooking oil or in cattle feed or in different types of crop protection, it stayed the preeminent company. But for that first 5 years post IPO, even the revenues compounded in double digits, profit compounding was close to zero. Hence, the market cap didn't move, and we believe there's a straightforward interventions that can be made in a company where your revenues are growing at double digits consistently, but your profits aren't growing. And once we assessed that management was more likely than not to make those changes, we loaded up on Godrej Agrovet. So I don't think Marcellus is going to be taking positions in companies where balance sheet is under pressure or it's a Fatawa brand. We're looking for preeminent companies. We're looking for niche dominance. But if you can get that in a company which for the last 3-4 years has struggled with profit growth, then so much the better. Because if you can establish that there's a hardworking management team in place, then under our ownership, under us being shareholders, the profit compounding comes through, and those who are listening end up getting enriched because of that.
Very well noted, Saurabh and Ashwin. So another question on the strategy line only is that while typically we buy small cap firms and allow them to grow over a period of time, we have seen some exits also in shorter time period, like Home First, Vijaya Diagnostics. So how do we decide at which step of, let's say, overvaluation we should come out of the portfolio, which company we let run?
So let me take that, Ashwin. So remember, these are niche market leaders, right? By definition, a Little Champs company is operating in a specific niche. So in Home First case, it's not just affordable housing finance, it's affordable housing finance by and large to salaried employees, albeit those with low salaries. Similarly, in the case of Vijay Diagnostics, it's diagnostics, but it's diagnostics in this specific context of niche markets in southern India, and then courtesy a recent acquisition in Pune, right? Now, with these small companies, both in terms of management bandwidth and in the addressable market, the TAM, the target addressable market, both are modest. The management bandwidth is modest, the TAM is modest. And in that context, when we see the stock rallying 50, 60, 70% in the space of, say, 12 months, and thus our math suggesting the TAM is getting depleted, management bandwidth is getting stretched out, we ended up feeling that much of the good stuff that the company could do, much of the target addressable market has already been captured, and the stock market is already discounting very aggressively the said companies, by and large, taking up the majority of their time. So with Chota companies, we need to be mindful that they are niche, and if the gobbling up the niche or the market is discounting the gobbling up of the niche in record time, then it behooves us to take cognizance of that and move towards the exit. In contrast, say, take GMM Pfaudler, global player, ceramic glass reactors, big market, and then beyond ceramic glass reactors, mixing solutions, the entire chemical factory solution piece end to end. Big market, GMM Pfaudler can go very far in that. No point prematurely getting out. And similarly, alkylamines, acetonide, not just acetonide, but aliphatic amines itself is a chunky market. And our call remains that there's considerable way that they can go. Tarson's even more so. Tarson's a tiny player in the global context. The only Indian company to be able to produce high quality laboratory equipment, pipettes, beakers, carboys, cell culture products. The only Indian company to be able to produce world class products. Go to any top end lab in India, speak to any top quality scientist at India's premier institutes like the Indian Institute of Science or IIT Mumbai. You'll see Tarsons is the one Indian company whose lab equipment products have global stature. But the giants in this market, Becton Dickinson, Thermo Fisher, these guys will be 100x Tarson's market cap, and hence no point worrying about Tarson's addressable market at this early stage of the evolution. Very different situation, however, on Vijaya Diagnostics or Home First, where very successful, high quality companies, but very aggressively growing into their addressable market.
Sure. So moving to some company-specific questions, while we have addressed Tarson's and alkylamine in detail, there is a question regarding Carousel as to who are the nearest competitors here, and does, let's say, somebody like a Sera has access to the same technology, quad zinc manufacturing technology, or how is the competition landscape for
Take that,
Carousel?
Saurabh. So Carousel, the competitors are actually, because it 70 basically most of its quad zinc revenues come from the global market. So understandably, the competitors will be global company. So the largest company of quad zinc manufacturer worldwide is companies like Shock itself, or the likes of Frankie, Blanco. These are all European companies. So these are the key competitors. They have the manufacturing capacity, as I said, largely in Europe. So these, in fact, I think there is no closest. I can't even think of any within India any competitor to Carousel in the quad zinc.
No, there's nobody in India. There's nobody who can remotely.
And where the differentiation with Sera comes is Sera is into water closet, and secondly, it makes water closet to ceramic technology, right? So it's quartz is a completely different material, different technology, and ceramic is completely different technology. So they are not competitors either in the end user segment or the product itself, the kind of material that is used in product. So as I said, like the technology which Carousel uses is the Shock technology. Clearly, it's a differentiated technology and it's suitable only for quad zinc manufacturing. So basically, there is no Indian competitor, and particularly Sera doesn't compete with Carousel.
There's another question about Rainbow Hospitals regarding, let's say, its recent performance, and do we have any view on when it can start doing well in terms of business fundamentals? I believe there was some drop in the PAT recent quarters. The question is regarding.
Yeah. So Rainbow, basically, again, there was a very strong YOY comparable for Rainbow during FY24. And as a result, optically also it got impacted. We think that FY25 should be, the company should do relatively well. And again, we don't see any reason why this is an evergreen industry, right? We are not seeing any pressure, even though there's a lot of talk about regulations in the hospital industry. But on the ground, so far, you're not seeing any any basically regulations coming into play. So I think FY25 should be a good year for Rainbow. It should be a business as usual. We've not seen any red flags as such, either the realization dropping or within Rainbow's area of play, any new competitors coming, any market share loss. So I think it should be a normal year for Rainbow and a normalized base. So FY25 should be a relatively better year than what FY24 turned out to be for Rainbow.
Okay. So there are a few questions which broadly are taking us to that, let's say, investors who have invested with us in last 18 to 24 months. How do we look at that? How next 3-4 years can be for them in terms of performance? So basically, our view on how LCP is expected to play out in next few years.
I think I should work couching the response in terms of ROCEs and reinvestment of the same, and what sort of earnings growth this portfolio deliver.
Yeah, so let me have, I think should have something here. Yeah, I'm not able to see my screen fully, but basically these companies have consistently delivered 20% earnings growth. In fact, the last 5 years of running this portfolio, seen every year this company delivering 20% plus earnings growth. This is also seen in the FY19 to 23. The only break and very unusual thing which happened is the last since the last 3-4 quarters, which we talked about. because of a confluence of reasons. Like one is the COVID-related base being pumped up for many of the portfolio companies. We used to have very high, 1/3 of the portfolio was on basically had exposure to chemical space at one point in time. Now it brought down to around less than 15%. But for example, that sector has not fired in the last 15 months. In fact, we have instead of earnings growth, we have actually seen earnings decline for this company. And also because of the geopolitical issues which happened in the last 2 years, many of the export franchise has not delivered what they historically delivered. So as a result, after a very long period of time, we saw the portfolio earnings actually falling significantly short of what they used to deliver historically. But as we show that there are green shoots of things normalizing for many of the incumbent companies, plus we making a significant portfolio correction, we think that the earnings should go back on that trajectory. In fact, if things normalizes quicker, we should see many of basically the 20% जो भी last 1.5 साल में नहीं आया, basically that in fact adding on to this 20% number.
Basically, just to summarize what you're saying, Ashwin, you're saying ROCs have historically been 20%. Since these companies reinvest the entire ROC, they reinvest pretty much the entire ROC. Historically, earnings growth was also 20%, in fact, a little north of 20%, where your red cursor is. The earnings growth, even in spite of COVID, was north of 20%. FY24 was unusual in that regard. FY24, for a confluence of global factors, the earnings growth was weak. But if we get back to the old trajectory, which all the signs are we are likely to, if we get back on the old trajectory of low 20% earnings compounding, then broadly speaking, that's where your compounding will also be. Go on.
And there should not be any negative factor from price to earnings. I think some of you may have in mind that portfolio expensive. Can PED rating kind of take away whatever is being contributed by earnings growth? Again, portfolio is trading at this point in time, 1 year forward, multiple of 30 times. So again, for companies which we have them in a potential to deliver 20% ROC consistently and 20% earnings growth, we think that 30 times 1 year forward multiple is very underappreciative of these franchises. So again, in fact, we could see some PE re-rating if the earnings growth come back for the portfolio. So yeah, so that is what we are banking on. First of all, the 20% magic mark for earnings growth to come back, and then some help from the PE re-rating that can. So in all, both of these combinations should indicate that the return should be healthy for the portfolio.
Thanks, Ashwin. So that was the last question for the day. In case there is any unanswered question, our team will reach out to the respective investors. Thanks, Saurabh. Thanks, Ashwin, for your time.
You.
Closing comments, Saurabh?
Yes, I mean, look, folks, keep the faith. We try our best to make money for you. We appreciate that. That 18-month period since September 22 through to the early part of this year was painful. In the last few months, the hard work that we put in over the last 9 months of rediscovering discovery. We've rediscovered discovery, as the name Ashwin showed you suggest. There's more in the pipeline. In fact, tonight is the review call for this year's batch of discovery. There's more discovery coming from the team at Marcellus. Courtesy the running around in the last 12 months. Ashwin and I have been to the interiors of Andhra, we've been to the interiors of Punjab, we've been to the interiors of Gujarat. I'm sure many such difficult travels await us because the LCP companies are seldom based in BKC, waiting for analysts to rock up to meet them. We usually have to travel to the back of beyond to meet these companies in their factories and see their profits of 40, 50, 100, 200 crores. So I think Ashwin is guaranteed more trips to tier 3, tier 4 cities. But the upside of that will be you guys benefit from the returns that he generates from discovery. As I said, broader Indian construct, the macro construct of UPI, low-cost broadband, GST, high-quality infrastructure. That's also great for these smaller companies. So sit back. If you're invested, then sit back and enjoy the benefits of the investments in the years ahead. If you're not invested, I think you know which phone number to call to load up on discovery stocks. Thank you so much for joining us today.
Thanks to all. Have a nice weekend.